Stocks. I'm Pamela Ritchie. We're in the early innings of the tariff impact really unfolding. As markets continue to shift, investors are reevaluating their exposure across geographies, sectors, asset classes. Today we explore how investors are navigating volatility and how a lifecycle strategy can help clients be on track towards their retirement goals. We'll also unpack inflation, tariffs, currency positioning, and what they might mean for retirement-focused portfolios like the Fidelity ClearPath Target Date funds. Joining us here today to share those insights is Jon Knowles. He's Institutional Portfolio Manager of Fidelity's Global Asset Allocation team. In today's webcast, once we introduce Jon, just one second here, will be presented in English with live French interpretation. So do join us in either official language and always send your questions in. You can use the Q&A function there. Okay, welcome, Jon. Great to have you here with us. Welcome to Fidelity Connects.
Thank you very much. Happy to be here.
Delighted to have you here, and we'll make sure questions come in and so on. Let's begin with what ClearPath is, and ultimately you'll take us around the world and how you invest that. But this is 80% roughly a fixed income portfolio, and then you add active. You have the ability to be active on the other 20% or so.
Yeah, there's a lot to unpack in terms of what target date funds really are. So the simplest way to think about a target date fund is that it's an investment solution that's really meant to take somebody from their early days of saving for retirement or a long-term investment goal, and really meant to take them all the way towards that time, that target date, as the name suggests, and then continue to de-risk beyond that. So when we think about kind of the foundational underpinnings of a target date strategy, we like to talk about the strategic asset allocation or the glide path. So as you mentioned, the strategic allocation is really what's going to drive about 80 to 90% of the investment risk and return. Bonds, but also equities in varying form as well. Yeah, build up a little bit of that nest egg. But as time passes, we recognize that the needs and sensitivities of individuals also adjust too. So we want to begin to de-risk the portfolio. That's why it's called the glide path, because you glide down it over time. And that means that we're selling a little bit of equities and buying fixed income on an ongoing basis, diversifying within equities and fixed income as well. But then we get towards the target date. If we're thinking about retirement, that could be sometime well into the future. Somebody's around age 65. And at that time, we'd have a mix of about 50% equities and fixed income. But then we would continue to de-risk, again, recognizing that somebody who's well into their retirement has a lot of different needs. They generally want capital preservation and maybe some inflation resiliency in their portfolio relative to somebody who's just retired and still has a longer planning horizon. So at our most conservative point, that's where we have the 80% fixed income, and the remainder would be equities, which really allows us to build this good foundation for our portfolio. So as we think about target date funds, we have the very interesting job of creating our benchmark on an ongoing basis. It's continuing to evolve. We say that the glide path lives and breathes because we make changes to it based off of what we see in capital markets, but then also what we see in the Canadian investor themselves.
So the Canadian investor, this is an institutional way of approaching things. There's quite a lot of money in North America put into this particular strategy, because you're working with the US as well.
Yeah.
How big is it?
I think it's sort of a lesser known fact in the Canadian marketplace, but Fidelity is one of the largest target date providers in the world, and we manage about $1 trillion in target date assets.
Okay. $1 trillion.
A trillion. Oh, yeah. So makes us one of the largest Canadian financial institutions, certainly if we were just looking at target date assets. But really what comes with that is a whole host of resources behind the scenes. Right. And that ensures that we can offer a very simple investment solution. We call it a one-stop shop. Takes you from early days of investing to your late stages of life. And that ensures that we have good operational support, lots of research, traders, portfolio managers, people that are just day-to-day dedicated towards target date investing.
So we'll talk about sort of the active side and the portfolio side and the equity side, and we'll get into that in a second. But what do you do with things like inflation over the course of someone's life of, say, age 25, as you said, I think up to 85? I mean, it is vastly different, obviously, the story today than it was way back then when you probably started offering them. So what do you do with the resources that you have to tackle that?
Yeah, inflation is perhaps one of the most interesting things when we think about multi-asset investment portfolios. So one of the frameworks that we use to think about diversification, and this kind of goes across some of the other strategies in our global asset allocation group, is we've studied history. We go back over 100 years, and we look at kind of what has transpired from an economic sensitivity perspective. And what we find is that there's generally 4 market environments that have occurred through history: rising rate environments, falling rate environments, deflationary stress, and inflationary stress environments. And what we see is that depending on which of those four environments we find ourselves in, the types of investments that we could own, whether it's equities, regional equities, fixed income, regional fixed income, cash, commodities, alternatives, whatever it may be, they have different sensitivities in those specific market environments. And what we've seen more recently as inflation has come back into the equation is that equities and fixed income are particularly challenged in periods of inflationary stress. And as I kind of alluded to at the beginning, a lot of our portfolios are equities and fixed income. So we want to think very deeply about who is most sensitive to inflationary stresses. Again, it's a life cycle investment solution. And generally what we think is that younger individuals, they have, if we think about the total picture of financial wealth that somebody has, it's financial assets and your human capital, your earnings potential. Younger individuals have a lot of earnings potential and not many financial assets. So that human capital is generally somewhat inflation resilient, or it has sensitivity to inflation over time. Your earnings kind of go up with inflation to a certain extent. So from a financial investment portfolio perspective, we maybe don't have to do quite as much because you've already got really good diversification. But as you get a lot older and you're in retirement and you're drawing on this pocket of money that you have to actually fund liabilities that are going up with inflation, we definitely think that you need more inflation resiliency in that point in time for those individuals. So things like global inflation-linked bonds that maybe have a shorter duration profile associated with them. Equities, Canadian equities specifically, are a very good sort of inflation resiliency investment solution that we can invest in. And then also Canadian real return bonds would be another example of something that's a little bit more close to home that has that inflation sensitivity associated with it.
So I mean, Jackson Hole's tomorrow. You can watch that closely. From your perspective, what would be good, bad, or just even Steven?
Yeah, so I mean, from an investment portfolio positioning perspective, we're probably not trying to get too mired in the day-to-day details of it, but I think it's fair to say that this is probably a pretty consequential speech or symposium. And the real reason of that is yesterday we got the minutes from the latest FOMC meeting, which the market sort of reacted to, but didn't really know how to interpret it, because since that meeting took place, we got a very soft CPI data print, soft jobs report, and the revision, which ultimately led to somebody getting fired. And then we got a very hot PPI. So there's a little bit of this mixed signals that's going on. So this will be one of the best times for the market to hear from Jerome Powell. And also we get the the take of the framework evaluation that they've been undergoing for the last little bit. And we'll get a little bit of more understanding as to how they're balancing inflation dynamics against the job dynamics, that dual mandate that they have, which is kind of, as the data suggesting, is maybe suggesting slightly different things in the current market environment. So just through Jerome Powell's experience of giving these speeches and coming to the market during the Jackson Hole, there's been 7 instances of it, and 2 of them have been fairly consequential, where the market's gone down more than 2.5%, and the other 5 have been somewhat benign. So there is that downside risk that something happens.
So do you think the discussion of a sort of a dual mandate is sort of, this is the thing?
Yeah, and I think that's what the market was kind of focused on based off the minutes yesterday, where the members themselves clearly see that there's risk to the inflation side of their mandate.
There's some dueling going on.
With a jobs market it seems to be that kind of at full employment. Maybe there's a little bit of softness more recently, and in pockets there's certainly more softness than kind of the broad data would suggest. But yeah, it speaks to this challenge that they have based off of all of the uncertainty, and we hate to use that word, but tariffs are really kind of throwing sand in the gears to a certain extent of the global economy. And I mean, one of the things that we like to look at is there's kind of 2 subsegments of the US ISM manufacturing index, new orders and prices paid. And what you typically see is that they rise or fall together. If there's a lot of demand, you can generally get better prices. What we're seeing is kind of this jaws are opening, where new orders are somewhat stagnating, but prices are increasing. And that's kind of that stagflationary backdrop, where you get slightly worse economic growth, but a little bit of that inflationary surge. And that continues to be sort of the base case that we have out of our global asset allocation team, based off of how this tariff narrative might unfold.
A little bit of stagflation?
A little
bit of stagflation.
Yeah.
So should investors in this particular strategy, in ClearPath, worry less when there are moments like the 2nd of April, everything went a bit crazy in the markets, but then again, by a week later, there were some opportunities and people got back in and so on. What's your team doing in that? Because you would think the investors in ClearPath are thinking, don't worry, they got it.
Yeah.
Yeah, you got it?
So at Fidelity, we're doing a lot and a little. So we're
Right.
spending a lot of time sort of reevaluating our research, ensure when things move very quickly like that, markets are repricing on a pretty dramatic level,
Right.
whether it's growth expectations, valuations, and we're spending a lot of time trying to understand, does it make sense? Is it overshooting? Is it undershooting? Where might there be opportunity for a longer term investor to really capitalize on things? I would say that during the actual sort of liberation week where things were moving around 5%, 10% per day, we weren't actually doing a lot of trading in the sort of asset allocation sense. From some of our underlying portfolio managers, the equity and fixed income managers, they were able to capitalize on opportunities on a more idiosyncratic basis, companies that were really getting sold almost in a liquidation sense, that they were able to buy at much more favorable valuations. But we want to take a much longer term perspective to this. So from a strategic perspective, we're thinking very long term, almost multiple decades,
Right, exactly.
in terms of the mixture of equities and fixed income that we want to have in the portfolio. But then from an active asset allocation perspective, we still want to think a little bit over a more intermediate time horizon, maybe 2 to 3 to 5 years. And generally, we like to anchor around this valuation. Where do we see that the market is mispricing? Either they're a little bit too ambitious based off of what we think is durable cash flows for an asset, or where are they pessimistic and there's actually, in our opinion, better growth that will materialize. So on a day like that, maybe not acting as much on our side of things, but there's certainly a lot going in the portfolios, and the research agenda fills up very quickly and you have to move things around. So one of the things that we see in the target date landscape is that target date investors are very good in periods of market volatility. We've seen it most recently. We saw it in 2022 when markets were declining pretty substantially from equities and fixed income and the inflation shock. And then in COVID as well, when we compare and contrast a target date investor to somebody who just does it themselves, they have a brokerage account or they just pick stocks or pick funds themselves, the difference in exchange activity is very substantial. Target date investors kind of just stay the course, they continue to allocate, whereas DIY investors kind of throw the kitchen sink at their portfolios to try and figure out what's going wrong and how can they reposition for the future. And generally what we've been able to study through time is that's not the right thing to do. And when we want to have this long-term, maybe retirement-oriented investment horizon, we really want to ensure that we're exhibiting good investor behaviors, right?
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
That's fascinating. So in terms of the active side of things, where you would be perhaps moving things around because there's an opportunity sitting right in front of you, is that funds that you're leaning into, leaning out of? Take us there a little bit.
Yeah, a little bit in terms of the underlying managers that we utilize, but I'd say more generally.
Anyone we know?
Yeah, certainly.
Really?
So we use Andrew Marchese, Joe Overvest, Will Danoffs in our portfolios. I mean, it's kind of the ethos of Fidelity is that there's a lot of all-star managers that make their way into our multi-asset portfolios, and that helps to drive the security selection performance that we have, but also brings diversification in a different way when we're able to complement Ramona Prasad, who has a slightly better value orientation, versus Will Danoff, who maybe has a little bit more growth and a core bias to his portfolio. So that's one layer of diversification that we can bring, and sort of active risk, if you want to call it that, in our ability to try and generate returns that exceed the benchmark. The other one would be, as you suggest, active positioning. So that's the portfolio managers, Bruno, Andrew, and Brett. How do they see the world, the market environment that we're faced with, and where are there opportunities? So I mentioned that we like to focus on things where we see there's value. That's kind of one anchoring tenet to our process. We recognize, like many people have probably said on this webcast, that valuation on its own doesn't really matter. You kind of need a catalyst.
Right.
We're fortunate that we have a slightly longer time horizon in the target date space. So
valuation
valuation
you can wait for something to
can kind of materialize,
okay.
but we need to be mindful of things like the ongoing carry or the income profile of an investment, but also the trend, what's going on behind the scenes. One of those that we're clearly seeing today is the trend in US equities. From a valuation perspective, you might be suggesting that you should lean against US equities, but AI is a very dominant theme. And when liquidity is abound in the market and there's a prevailing narrative that people seem to be gravitating towards, you need to be cognizant of not only emphasizing the valuation side of things, but also being aware from a risk perspective of other things like carry and the trend.
Fascinating. So does that lead to a yes and? So yes, US, AI, US, tech, and the rest of the world? Because if you talk about a trend from this year, certainly the rest of the world trend has been a big one.
Yeah, so we've fortunately been able to capitalize on that, which has been fantastic. So maybe just to kind of provide some overarching color of our positioning. So we're overweight pretty much non-US equities. So we're overweight equities in general, overweight Canadian equities, international developed and emerging markets. And part of the punchline there, I would suggest, is that we've come into this year with fairly low valuations. And with that, very low expectations about growth, the potential for growth in the future as well. And that creates a little bit of asymmetry where we at Fidelity believe there's actually better potential for growth in some of these markets than the market is pricing in.
And you can wait for it.
We can wait for it. And say somewhere like ETH or Europe, Japan, you actually get a very good payout or distribution, whether it's the dividends or the buybacks, that's actually exceeding that of what you get in the US. And you get a better valuation that you pay for it when you allocate to those markets. So there's, in our opinion, a little bit of asymmetry in terms of lower valuations going in, lower growth expectations that we think can surprise to the upside. And you really do get paid as investors for getting those surprises right, whether missing the ones that surprise to the downside or capitalizing on the surprises to the upside. And then back home in the US, or back in the US, not back home, excuse me.
Well, that's where part of your team is.
In the US, we really do see this kind of durable theme in AI that a lot of our underlying managers have been able and rightly able to capitalize on. But if you kind of go beyond the Mag 7, you see more challenged profitability perspectives, certainly higher valuations for pretty much everything in the US. The Mag 7 is maybe okay because you have such sustained growth that's almost kind of eye-watering and it just continues to manifest. But if you go beyond that, it's a little bit more challenged. And I think one of the things that the global asset allocation team at Fidelity does really well is researching these slightly more structural trends in the marketplace. And one of the themes that they've been highlighting to us over the last couple of years has been one of maybe more challenged profit margin and profit growth in the US. So what we've been doing is looking back over the last 60 years and kind of comparing and contrasting productivity versus profit growth. And we've seen kind of a boom in the last decade of profit growth relative to productivity. And part of the explanation, we believe, is that you've had very favorable dynamics across globalization. Interest rates have been very low, and CapEx has also been very low.
And all that's changed.
Yes, all of that has changed.
Yeah.
It doesn't really seem to matter for the Mag 7. They can spend as much as they want. They do get slightly better interest rates.
Was a nothing.
Yes, but the profit margin story is maybe a little bit more challenged on a going forward basis for all three of those reasons that seem to clearly be changing in the US market.
So, I mean, that is a regime change. It's nothing new. People have been talking about this for the last several months now and watching this. There's a couple of questions going back to the process. So why don't we take all of that and sort of put it into how you work with this. From a know your product perspective, how do you suggest comparing ClearPath portfolios against other portfolios? This viewer goes on to say, I'm not sure how many other target date funds are in the Canadian space. So yeah, just a little bit of situating us.
Yeah, so maybe to take the back half of that question first. So there's actually not that many target date funds in the retail side of the Canadian marketplace. A lot of the Canadian target date players have really focused almost exclusively on the institutional marketplace. So when we think about the Canadian target date landscape as a whole, we generally have most of the assets that sit in the institutional world. We estimate that it's about $130 billion of target date assets in the Canadian marketplace. And then on the retail side, it's much smaller. It's maybe about $7 or $6 billion. And we would probably be the primary player in that space from a retail availability for target date strategies. So I would say that in terms of the options for competitors in target date space for retail advisors, it's certainly a little bit more limited. As it relates to the first part of the question and maybe some know your client considerations, I would say that target date's going to be different. It's going to act differently than just a traditional maybe multi-asset investment fund or a balanced portfolio in the sense that it's going to continue to de-risk through time. So depending on where we are in the life cycle journey, you're either going to have a static allocation to a certain extent for younger individuals, or an allocation that's becoming more conservative through time. So it becomes a little bit more challenging to fit it kind of one-to-one relative to a balanced portfolio, whether it's an 80-20, a 60-40, or a 40-60. We have portfolios that kind of align with all of those different categories, but you need to recognize that over time, it's really meant to reflect the investment allocation that somebody should have. It's meant to kind of augment what a financial advisor is doing, is having those conversations and understanding the needs and sensitivities and how they evolve of an investor. So that's probably the biggest thing to be mindful of in terms of making the allocations.
So when you read about this fund and this strategy, you'll hear a lot about roll down.
Yes.
Take us through that. This is making use of when bonds are coming to maturity, essentially, and how those fit into the portfolio. But how do you describe it? Not Investopedia. But how do you describe it?
Yeah, so every target date provider has a different perspective on how they want to manage that roll down process. We do it on a monthly basis. We believe that that gives a little bit more of a gradual ride for individuals. Okay. But I'd say that this is very much a gradual ride. We're not selling 5% equities and funding into bonds on any given month. It really is like a couple of basis points that's occurring over a number of years. So it's really meant to be this long, drawn-out life cycle investment approach where we recognize that as you transition from age 57 to 58, your needs don't change dramatically, and therefore your portfolio shouldn't also change dramatically. It should be this managed de-risking process.
Okay, that's super interesting. How do you make decisions around asset classes? I mean, you just mentioned a couple of minutes ago, we lived in a zero interest rate world. It was a very globalized world. What was the third thing you said?
Yeah, so inflationary, deflationary, rising rate.
Yeah, well, you were just talking about how different the world was, even a year ago, in terms of how we thought about everything from supply chains to, the outlook for inflation and so on. So how do you make decisions around asset classes? For instance, commodities. I mean, how do you watch these cycles? You see how things should be further allocated to or not. How do you sit down and make those decisions?
Commodities is an investment that a small allocation actually goes a very long way in the context of diversifying against equities and fixed income. And in target date, that's the majority of our investments, and it's really where the risk comes from. So when we think about the current environment that we're faced with, one that's inflationary or has inflationary embers that are still ruminating out there.
And has changed so much.
Has changed so much, yeah. And part of that is just what drives equities and fixed income is when the market is really focused on inflation, that leads to generally higher interest rates, higher discount rates, and that hurts both equities and fixed income. So having a little bit of an allocation to commodities is certainly helpful as a diversifier. Maybe doesn't work in every single month or quarter, but certainly helps to balance the risk profile of our portfolios, and it's an active allocation that we have today. And then maybe if you just think about kind of the current market backdrop, we still do have quite a lot of geopolitical noise. Uncertainty is still through the roof. You have governments that are spending like we're in a wartime economy, and a lot of those things kind of continue to have a belief that inflation could continue to fester in the economy for some time.
The fiscal dominance story. Yeah, absolutely. What then of taking a look at how we all think of bonds? It also, for those same reasons, the world has changed, and bonds were something very different when they were 0%. And then we've gone through this inflationary story, and now we think deflationary story. There was a lot of discussion of make sure you have some bonds, even if you don't need them, even if the market doesn't crash, you can just clip some coupons. Coupons will be fine. You know, bonds, is that the right way to be thinking about this?
Bonds fundamentally are a much better spot today than they were many years ago. You have very high interest rates. I'd say that there's a little bit of a conversation about sort of spreads versus just the sort of government level of interest rate and what's really driving the underlying sort of interest rate that you get on a given bond. But just generally speaking, you end up with pretty strong absolute returns. Now, we would say that generally there's going to be continued noise around interest rates, and it's going to lead to slightly higher volatility of those investments than you might otherwise expect in sort of steady state market environments. But that doesn't warrant a decision to hold no bonds. Bonds are still a great diversifier, and when you have a much better going in interest rate, if we do end up in a recessionary period or markets just get spooked for some reason, there's certainly going to be a strong counterbalance to equities in your portfolios. We have a general preference towards inflation-protected fixed income over just nominal fixed income. You get a little bit more of that inflation resiliency in there. There's a bit more sensitivity to what's actually happening in interest rates. or inflation, excuse me. And the market is, I'd say now starting to wake up to the fact that maybe inflation is here to stay a little bit more. So that pricing is narrowing a little bit. It's not quite as advantageous as it was maybe a year ago, but it still kind of pays you to wait to a certain extent in those investments.
Yeah. Okay. Well, that's kind of what we hear. What do you do with such a long time horizon, which is great if you do have lots of 25-year-olds under you, but even if they're a few years later than that, the demographic story changes, regulations change, all kinds of things change. You're obviously taking that into account, but maybe just give us a bit of a taster of what you've had to take a look at on the demographic side of things and kind of regulatory landscape that you fold into this strategy.
Yeah, target date is exciting in that sense. And we're not just looking at capital markets. We also spend a lot of time on the Canadian themselves. And how's the Canadian changing? I talked about needs and sensitivities, and that's kind of through the life cycle journey. But the end goal is also giving people an investment portfolio that they can draw down in retirement, and we'll give them some retirement income to supplement things like CPP or OAS. What we're seeing seeing on sort of a rising fashion is what we're calling this sort of encore era. That's what our folks down in the US are dubbing it. But essentially what that is this phased transition of retirement where people are no longer going from working to not working. They're having a little bit of a transition where they go from working to working part-time, or they work, they stop working, that doesn't really work for them, and then they pick up a part-time job again. So we're seeing the early years of people's quote-unquote retirement actually having differentiated retirement income sources, and one of them certainly being employment income, which is a lot different than we've seen historically. The other thing that maybe has been a blip on the radar in the last couple of years, but people are living longer. Advances in sort of medical technology and healthcare are really helping people get more out of their life for longer, which has ramifications in terms of how much people actually need to spend.
Right.
And what we care a lot is studying that retirement duration. So we touched on that flexible retirement age side of things, and then the mortality experience on the other side. And it's the one minus the other that really gives you how much retirement income do you need to try and fund. So there's a lot of different things that we're trying to triangulate in terms of coming up with an investment solution that fits a wide swath of the Canadian population.
Why is it called ClearPath? Maybe just take it back to the target date piece as we kind of close out here.
Now it's started to be used for other investment solutions or investment objectives, like saving for a house or a child's retirement education vehicle as well. But it's really meant to be this kind of set it and forget it, as I've mentioned before, path towards retirement. So I guess there's a degree of clarity in terms of once you made the investment decision, it's about ongoing contributions and kind of sitting back and watching as your account balance grows.
Thank you so much for teaching us about this. It's really great to meet you. Thank you, Jon.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.